he's picked a fight with the market and the long end. I think it goes higher. I'm not bullish the dollar. I've not been bullish the dollar. Ultimately, the Fed has to get involved here with some sort of QE or yield curve control. These are dangerous band-aids because at some point they unwind.
Do you think he has enough firepower to ultimately change things?
I'm actually somewhat worried about.
Bond yields are snapping back today on August 20th, following the U.S. Treasury's announcement yesterday on the 19th that they would double their bond buyback program. That had a huge impact on all markets.
So talk us through what you were trying to do here by announcing the increased size of the buybacks.
Yeah, we're trying to signal that we think that this is a thinly traded area of the market, that we're in August, and there's been a lot of corporate issuance that's influenced the market. And we believe that there are many underlying factors that the market is not looking at, and we are going to make a market in these. We routinely do buybacks, and we're going to increase the size of the buyback. And Sarah, I would note that it could be more than the $4 billion per issue.
With gold rallying 3%, Bitcoin rallying 5.5%, and the S&P and NASDAQ both rallying. And that move, although nothing's been done yet, they announced that they would double their bond buybacks from $2 to $4 billion, but they haven't done that yet. Although they haven't done it yet, this announcement itself was enough to signal to markets that the Treasury is willing to do whatever it takes to cap the long end of the interest rate curve before what many economists would describe to be an economic catastrophe if yields go much higher. Now, today on Thursday, stocks are down. The NASDAQ is back down. It's down 1%. Gold and Bitcoin are still up. They're maintaining their rally with gold up about 1%. Bitcoin up another 6%, which we'll talk about today. And the Treasury yield is moving back up. So the 30-year is up 1%. Peter Boockvar, CIO at One Point BFG Wealth Partners, is here to give us his outlook on not just the bond market, but the entire economy. What is the Fed going to do next in response? And what is the Treasury going to do next? What bazooka, so to speak, is Scott Bessent likely going to fire next, given that whatever announcement he made yesterday was not enough to keep the long end of the curve down? This video is brought to you by Kalshi. It's the largest prediction market in the United States. Unlike a sports book, you're trading peer-to-peer on real-world events, from economic data to political outcomes, and the price moves based on public opinion, not a house. Go to the link in the description down below or scan the QR code here and use my code LIN, L-I-N, to get a special promotion. New users can get $25 when they trade $25. Kalshi is CFTC approved and available in all 50 states, including California and Texas. And right now, there's a very important trade going on, which is how high the 10-year yield can get at the end of the year. Traders are placing a 53% chance that it'll go to 4.75 or above, and only a 32% chance that it'll go up above 5%. Peter's going to give us his outlook on where the 10 years headed, despite the Treasury's recent interventions. And if you believe that it'll go above 5%, and if you put, let's say, $50 down on that particular trade, your payoff could be $144 or more. So stay tuned for Peter's outlook and his answer to this question. Welcome back, Peter. Good to see you.
Thanks, David. Appreciate having me back.
A sharp move lower for yields yesterday and a sharp rebound in yields today. The 30-year is up 90 basis points. It was at one point earlier in the day up 1.1%. Why the sudden reversal?
I think it's a couple things. I think what Bessent is trying to do, is rather complicated in the sense of the potential ripple effects, that there's no free lunch here. First of all, we're talking about a very tiny size. $2 billion buyback going to $4 billion. That doesn't move the needle. Now, from a signaling standpoint, it obviously reflects his disappointment with where long rates have gone. And he was on CNBC talking about even enlarging that buyback. But this is not the Fed doing it where they could just print money. He needs to raise money in order to do this. And we assume he's going to sell more T-bills in order to buy longer dated paper. Now, on one hand, a positive of buying longer dated paper is most likely he's buying bonds that were issued before 2022 and that are probably trading at 75 to even 50 cents on the dollar because of the sharp sell-off in those bonds since 2022. So on one hand, he's buying back at a discount these bonds, which instead of paying back $100, 100 cents on the dollar when they mature, he can pay you back at 50 cents on the dollar. On the flip side, though, is he's giving away, by retiring, low-cost debt for the U.S. government, and he's replacing it with T-bills that are going to cost him 3.75% right now, going out to about a year. And if he issued more to the 2-year, it would be north of 4%. Also, what do you tell Kevin Warsh if you start further front-loading T-bill issuance? Do you tell him, well, Kevin, if you end up having to raise rates again because inflation flares up, well, it's going to cost me as Treasury Secretary even more in interest expense. Also, we have to watch to see the dollar. Will the dollar be collateral damage here because of what he's doing, both from a confidence perspective and also his attempt to lower rates, highlighting, the debts and deficits problems that are clearly here. So we saw a very sharp rise in gold, nice decline in the U.S. dollar, where the DXY is now at a 3-month low.
You wrote yesterday on your Substack, actually earlier today, rather, this morning it was published. As I see, the buyback is nothing more than what FX intervention brings, a temporary respite. I don't think it works without a coincident fundamental change to the situation. All right, tell us more about this fundamental change. Basically, whatever Scott Bessent is doing is not enough. Is that what you're saying?
Yeah, doing what he did alone is not enough, just as foreign exchange intervention is not enough in terms of sustainability unless there's a change in the fundamentals and policy. Bessent tried to explain himself again on this CNBC interview where he talked about fiscal consolidation. I like Scott Bessent, but good luck with that when you're dealing with the U.S. Congress. To me, there's no chance that he'll be able to implement fiscal consolidation of any sort. They tried with Doge, which I appreciate the attempt, but it certainly didn't get very far. So until you deal with the entitlements, until you deal with other big ticket items within the budget, there's going to be no such thing as fiscal consolidation, because you can be sure that no one in Congress really cares about what's going on, because none of them will get reelected on a campaign and a platform of fiscal austerity. So I think he's just giving it a shot, hoping that he can scare the market enough. But again, getting back to the analogy earlier on foreign exchange intervention and the history with that, it tends to be very fleeting in impact.
Well, it seems to a lot of people that the government, in particular the Treasury, has decided that a certain interest rate level is too high, hence the intervention. So do you think that, extending that analysis further, do you think that maybe they have a target, a soft target in mind, at which point it would be acceptable?
I don't think they have one just yet, but it's clear that informally or unofficially, 475 is one of those lines in the sand, because that was the level just below where we were when he made this move. But again, to make a point, this move we know came just a few weeks after he intervened and started buying yen with euros and offered the Japanese that Fed facility. So it's clear that around these levels, he's not happy with. I'm wondering why he picked this level as opposed to call it 5% or something more. If we got above that, 5% was where we traded for about a day in October 2023. But now when you pick a fight with someone that's much bigger than you, you better bring enough ammo to that fight. And the bond market is much bigger than him. And getting back to my comment about the dollar, if the dollar were to weaken from this, number one, it potentially creates inflationary issues. And number two, it could actually facilitate foreign selling of U.S. assets for those holders who are not hedged, particularly foreign holders of U.S. Treasuries, which that totals still about 30%. So this is a game of whack-a-mole. You have to pick what you want to achieve, because there are going to be negative offsets to that, and how are you going to weight each one of those outcomes, I think, is the question. But it's clear that the bond market, with how you started it, how the yield has essentially gotten back what it lost. The bond market is telling Mr. Besant, is that all you got, at least right now?
So the ultimate question is to the bond market is what is going to happen to the yield curve. So the 10-year yield at the end of the year, this is a trade on the Kalshi prediction market, only 32%, traders are placing only 32% chance of above 5%, is basically Scott Besant telling us 5% is the cap, because that's what people were reacting to yesterday.
Maybe, but he's going to have to come to the table with a lot more firepower than $4 billion. And he said that maybe he will, but he's not printing money to do this. He's doing a different form of Operation Twist here, but to really front load U.S. T-bills in order to do this, it's just a dangerous game he's playing. But it's clear that he doesn't like rates where they are, and that's a situation that we face. And it's not a rate issue just in the U.S. It's in Japan, it's in the UK, it's in France. Yeah. Germany's even feeling it, even though they have the lowest budget deficit relative, or I should say debt to GDP ratio compared to its peers. But this is a global phenomenon. So he's potentially spitting in the wind here.
What's your take then? Do you think he has enough firepower to ultimately change things? And if not, where do you see the 10-year headed?
He does not. I think it goes higher. Mm-hmm. What's clear, though, is maybe ultimately the Fed has to get involved here with some sort of QE or yield curve control. But these are dangerous band-aids, because at some point they unwind. And to implement yield curve control is an extraordinarily expensive thing when inflation is a problem. See, this is what ties the hands of the U.S. government, is that inflation is still an issue. Now, a lot of this rise in rates since the end of February have been real rates. Inflation break-evens have been relatively benign and actually no higher than they were before the war started. If inflation expectations now start to rise, and the inflation numbers do as well, because oil prices go much higher, or commodity prices generally, and so forth. And the Fed is almost forced to be hiking interest rates in response. Well, how does that play off what Besant's doing, where he's front-loading T-bill issuance at the same time the Fed's being forced to raise interest rates, which actually raises your interest expense, which actually creates more debts and deficit problems, which then further raises the long end of the yield curve in terms of yield. This is a real box that they're in. Well,
there's been speculation as to how liquid these bonds are going to be. This is their press release from yesterday. The U.S. Department of Treasury is increasing buyback by at least double the size. They're going to target 10 to 20-year sector and the 20 to 30-year sector. Do we know, or do we have any information, or can we speculate as to where they're going to be buying these bonds from? Where are the books coming from?
That's not clear. I mean, they'll issue like tender offers, and we'll see, who the sellers are. He did, getting back to the CNBC interview again, he talked about the illiquidity of the long end as being a rationale for what he did. The problem with that is, the more long end paper you retire, the less liquid that they become. So if you want to add liquidity to the long end, then you issue more of them. You don't retire them. So to me, that was sort of a lame excuse. Part of me thinks that he understands that, and he just didn't like the level. And he felt that in his hedge fund days, this is something that he can step in on, and he did what he did. But I think, unfortunately, there's going to be egg on his face if this doesn't sustain itself in terms of putting a cap on yields.
To the layman wondering why this is all important, how would you explain the impact of the long end of the curve on the economy? If the 10-year goes above 5% and stays there, what happens to everything else?
Well, it's very easy to understand if you're looking to buy a home. understanding that your 30-year mortgage rate that you're trying to lock in is priced off where the U.S. 10-year goes. That's simple. And then with respect to businesses, well, most businesses, you have the SOFR plus that are okay because SOFR is pretty much following where the Fed funds rate is. But many businesses, commercial businesses, real estate, they're borrowing off the 5-year and the 10-year. So they're going to be very sensitive to where yields go and that sort of belly to longer end of the curve. The 30-year we talk about, but outside of pension funds and insurance companies buying them, no one borrows off the 30-year Treasury yield. It's really 5s and 10s that are the most sensitive to what's going on here in terms of lending rates and borrowing rates.
Do you think that if Kevin Warsh and the FOMC raise interest rates, the Fed funds rate specifically, by the end of the year, that is all it takes to bring down the long end of the curve? In other words, the bond vigilantes don't need to do anything anymore?
No. If the rise in long rates was because inflation expectations were spiking, then I would say yes. A rate hike would calm those fears down. But this has not been inflation worries. Now, at some point it will be, I believe. But because this is a rise in real rates, I don't necessarily think a rise in the short rate will then cap the long rate. But again, if inflation does become a problem and Kevin Warsh needs to get more aggressive, then maybe yes. But at least right now, I hear that argument. Well, he needs to hike to calm the long end. Well, I'm not so sure about that for reasons just stated.
People have likened this yesterday to Operation Twist, which is lowering the long end, raising the short end of the curve. Why hasn't the 2-year moved on this yet?
Well, the 2-year is still pretty much tethered to the Fed funds rate. And, it is a bit different because the Fed, when they did it, they actually sold existing short-term paper that they owned. Now, Besson is going to issue, so there'll be still a price effect because we'll get more supply on the short end. But, the difference is more semantics than anything. That's what they're trying to accomplish here. But there has to be follow through in terms of policy, and I would fade that any day, and to the belief that we may get it.
You rightly mentioned that this had an impact on the dollar, so the DXY direction towards the end of the year. If your view is that eventually the long end of the curve will still go up, are you bullish on the dollar still?
I'm not bullish the dollar. I've not been bullish the dollar.
Okay.
The dollar obviously had its rally post the beginning of the war. Kind of a lame rally, wasn't much of one. And I think the dollar's got a lot of challenges. I think there's a major diversification going on in terms of trade and capital flows, which over time is going to be dollar negative.
You also wrote in your Substack this morning, I wonder what Bazooka gets pulled out next, if I'm right.
Well, if I'm right that this is not going to work.
Right.
And that's the question that Scott Besson needs to answer is, okay, if there's no follow through here in rates, what's next? Well, he sort of said it today that he'll do more, but is that it? It's like that's actually the typical government response is let's spend a lot of money or let's try a new policy, and if it doesn't work, well, then the answer is just do more of it, thinking that maybe you'll get another outcome. But so we'll have to see where this goes. He's picked a fight with the market and the long end, and that the market's very big, and we'll have to see how this goes, of course.
I guess Trump could just announce that he's going to cut spending, if one can imagine such a thing.
I don't know what he's going to be able to cut, particularly ahead of the midterms. You're going to tell a retiree, I'm going to cut your Social Security or healthcare benefits? Yeah. No. Are you going to tell the defense industry, as we're in the middle of a war, we're going to cut that? No. Interest expense, well, that's locked in, so you're stuck. There's nothing they can do.
Why do you think Bitcoin, we talked about gold a little bit, we can come back to gold, but Bitcoin I want to come back to. Bitcoin hasn't moved all month. Even when gold spiked at the end of July following the yen intervention, Bitcoin was flat all the way up until yesterday. Can we speculate as to why Bitcoin all of a sudden moved 12% in the span of a day and a half?
Well, you had all those crypto people in the White House. They're all trying to get this legislation passed So I'm guessing that's part of it. Now, interestingly, Bitcoin rallied with gold, but in Bitcoin's 17, 18-year history, it's been called digital gold, but it really hasn't traded like gold. So maybe this is the beginning of it acting like gold, which I think if you're a Bitcoin holder, that's what you should want. You should want it to correlate with gold and not with the NASDAQ, which it has been up to this point in its history. So we'll see. Maybe this is a sea change in how people perceive Bitcoin. Because if it doesn't follow through and continue to trade like gold, well, maybe, as I said, it just had to do with the legislation that is trying to be passed, and all the crypto people that were in the Oval Office this week.
Can you explain the relationship between bond yields and stocks? To my understanding, the relationship is not always consistent. Sometimes they're inversely correlated, sometimes they're positively correlated. So,
well, if you look at the 80s and 90s, declining interest rates and led to higher multiples that people were willing to pay for stocks. Not only that, lower inflation is actually good for economic growth. So that also helps to lift earnings. So that's why both can rally together. Now, of course, we've seen bonds sell off since 2022. I mean, we're 4 years into a bond bear market, I believe. Most stocks haven't cared because the level of rates historically is still relatively benign, where I should say now we're sort of in the range of historical levels. But I think we're reaching an inflection point. And also, of course, the whole Gen AI trade was immune to the cost of capital because the spenders were going to spend no matter what the cost of borrowing was. But now we've reached a point, I think, where equity investors are beginning to care because we're reaching some levels that even, the Treasury Secretary has drawn a line in the sand on.
I'm just going to pull up a chart from the St. Louis Fed here. Non-financial corporate debt. This is in millions of dollars. Let me just show an annual percentage change. It has been climbing, although the rate of change hasn't been higher than what it was averaging historically. The point is, at these levels, are you concerned that corporate debt can't refinance at much higher rates or even at current rates?
Well, that'll be the test for corporate America over the next couple of years, particularly lower level credits. The thing that has really stood out to me this week is that the CCC category of high yield bonds, that spread has widened out to above where it was the Liberation Day last year. So at least the lower end of the high yield market is beginning to get worried about something. And that is a big yellow flag for me that I am paying attention to. Now, how it will go in the refinance cycle in the next couple of years, I'm actually somewhat worried about the private credit refinancing schedule the next couple of years. Number one, at least retail inflows have dried up. And number two, a lot of the loans that were given in the last 3 to 5 years are going to come due over the next couple of years. And we'll have to see what the credit lending and rate environment is under that situation if private credit has a slowdown in their inflows, because maybe they don't want to refinance, or if they do, it's going to be at much higher rates that these businesses can't afford.
Let's look ahead at the FOMC and what they're about to do. So we've seen what the Treasury has done this week and earlier in the month when they intervened with the yen market in Japan. Now, do you think the Federal Reserve and the Treasury are aligned in their outlook or their expectation for what the yield curve should look like?
No, I don't think so. Now, if Kevin Warsh and Scott Besson want to be aligned, that's one thing. But Kevin Warsh has a committee that a lot of them want to raise rates. So the Fed raising rates, I don't think is on Scott Besson's wish list. So I don't necessarily think they're on the same page. I think
Fed raises rates. I'm sorry, please go ahead.
No. I mean, I get the argument that if they raise short rates, maybe long rates fall. But as I argued earlier, that would be the case. That would probably be the case if the rise in lower rates was inflation concerns. If it's debts and deficit concerns, I'm not sure if that's going to be the flow through.
That makes sense. So then ultimately, if they both have their own independent agendas, how does this conflict get resolved, and how will the markets respond to any dichotomy in policies, fiscal and monetary, you think?
Well, how it gets resolved, we're trying to figure out for sure. I still think that long rates continue to head higher. And again, not just here, but globally. And, that's going to eventually be a problem for the equity market. So that's where I'm concerned. So I don't think that we're reaching like sort of a resolution. But I think that we're seeing that the government is clearly worried about where we stand, but will anything come of that substantively? I'm very skeptical of, outside of these gimmicks that they're going to try to pull off to cap the rise in long rates.
Okay. Well, the annual Jackson Hole Symposium is coming up next week. It's a gathering of central bankers. This will be Kevin Warsh's first as Fed chair. What are you expecting?
I don't know if there's really much he can say. He's not really into giving forward guidance, so he's not going to tell us what he thinks going forward. His hands are tied in multiple ways. Number one, the fiscal side, budget deficit that the bond market's obviously worried about. Well, he's got no control over that. Oil prices are approaching 90 here. He's got a problem with that, and he's watching closely what, if any, of the secondary effects are from this rise in energy prices. And again, it's not crude oil. We don't eat crude oil. We don't use crude oil. We use products. But product prices obviously are very high, and the spreads are very elevated. So I think he's really stuck. And I think he doesn't want to hike, but there is growing pressure for him to do so. But I don't think he's going to want to tell you that at Jackson Hole, because he says he doesn't believe in forward guidance.
And you mentioned offline, I've been reading this as well, agricultural commodities have been going up in price. This is probably one of the clearest signs that inflation has spread beyond just oil itself. Tell us more.
So as we are speaking, the Bloomberg Agriculture Index, which includes corn, wheat, soybean meal, sugar, cotton, coffee as well, that is at its highest level since May 2024. Last year, we had a precious metal industrial bull market rise in those commodities. This year, we've seen an energy bull market, and now to me it's spreading to ag. And the fertilizer situation, I believe, is going to continue this bull market into next year because farmers are having a difficult time affording fertilizer, which means they're going to use less of it, which means that there's going to be less nutrients in the soil, which means historically that when harvest comes, there's going to be less yield, which will result in higher crop prices. So I think that is ahead for us.
What needs to happen to this for this to turn around, you think?
Well, on the ag side, the ag compared to the long-lived cycles of other parts of commodities is short cycle. I mean, every year there's a planting season and there's a harvest, and South America has two of each of them, so it can sort of fix itself with robust crops. So, but getting to my fertilizer perspective, if farmers can't afford to buy fertilizer at current prices and they use less of it, well, then you're not going to get the same robust yield. So what farmers are going to need is they're going to need higher crop prices in order for them to afford higher fertilizer prices to properly seed their land, which would then eventually get to better yields. So that's sort of the processes that are going on here. But for now, I do think we're going to see higher prices, and the ag stocks are going to benefit.
Now, I know agriculture commodities move up and down all the time, depending on the season and depending on the markets. As this chart shows, this is the Bloomberg Agricultural Commodities Index. But I wonder how sticky it would be for food prices at the grocery stores and food away from home, those components of the CPI. I've never personally known restaurants to raise prices and then lower them after some event. And very rarely do we see grocery prices for items go down, even if agricultural products go down. So I wonder if this right now will have a permanent impact on food inflation going forward. What do you think?
Yeah, I do think it'll give reason for another hike in prices that, as you allude to, don't get ratcheted back when input prices fall back. Now we'll have to see on crop prices. This is just an initial move. They can easily fall back down again. But $7 wheat, $5 corn, approaching 13 soybeans. These are levels that, if they hold, there aren't many things that piss people off more than higher food prices. Higher gasoline prices do as well. But if you have them both at the same time, that's going to be an issue.
Okay. Finally, then, any changes to asset allocation priorities since the end of July, beginning of August, given everything the Treasury has done so far or announced, and given the moves in the markets since the beginning of August?
No, I mean, I think we're properly positioned. Portfolio that I run, I've about a third in commodities, commodity stocks. So I'm already there in terms of this, what I believe is a bull run. Certainly, what Scott Besson did was not on my list of things to expect, but on the fixed income side, we're more in the U.S. short duration anyway, and to my belief that the dollar will ultimately end up lower doesn't affect my belief to also own international stocks and international bonds, particularly in emerging markets that would benefit from a weaker dollar.
Okay. Excellent. Thank you so much. Tell us where we can follow you and learn more.
So on the wealth management side, onepointbfg.com. They can check out our website and learn more. On the writing side, I write every day on Substack called The Book Report, BOOCK report, and on the markets, economics, macro, micro, every day.
Okay. We'll put the links down below. So please do check out Peter's work. And we'll see you next time, Peter. Take care for now.
Thanks, David. Appreciate it.
And thanks for watching. Please do like and subscribe and follow Peter in the links down below. And don't forget to use my code LIN, L-I-N, when you sign up to Kalshi. Remember, new users who use my code can get $25 when you trade $25. Link down below or scan the QR code here.